Hello and welcome to Outlook Money's Investment Made Easy podcast series. The series is spearheaded by ICICI Prudential Asset Management Limited. I'm Nika Shah from Outlook Money and your host for this session. The topic of today's episode is stock versus ETFs. Which should you buy? Investors often get confused between investing in stocks and ETFs as both are listed on the stock exchanges. However, there are some inherent differences between the two, and in most cases, the choice may depend on individual needs. In this episode, Mr. Chintan Haria, Head Product Development and Strategy, ICICI Prudential AMC, will tell us about the differences between ETFs and stocks and their suitability for various investors. Welcome, sir, to this episode.
Hi, Mika. It's good. I think we are entering the year end, and I think 2023 also has good prospects for India. So,
Definitely, sir. So let's start with our very first question. Could you please help our listeners understand how investing in ETF is different from investing in stocks?
Mika, if you look at from an investment standpoint, investors are today, in fact, with 10 crore demat accounts and increasing, investing in the stock markets directly through stocks as well as ETFs are also growing in popularity. The difference being that when you invest in a single stock, you are exposed to the risks that are there in that single stock. It could be the individual management, it could be the uh, particular sector in which that stock is. Uh, Many things can go right and wrong in an individual stock, which can change the return risk profile from an investor standpoint. The investor will have to do a lot of research before investing in a particular stock and ensure that the stock does well. However, if you're investing in an ETF, by definition, ETFs are diversified in terms of having, let's say, 20, 30, 40 holdings, anywhere more than 10 holdings. So you'll get diversification. And also, if you look at from an ETF standpoint, there will be a methodology through which the combination of stocks will be selected and their weightages will be put. So let's say if it's a large cap ETF, you'll have the top 30, top 50 names. So you have diversification. For most investors who don't understand markets, ETFs are the first step towards investing in a diversified manner in the markets. And then once they understand markets more deeply and are able to study the individual stocks, maybe that's when they should invest in individual stocks, because the systematic risk and the unsystematic risk. Systematic risk essentially is something which is part of the market itself, but unsystematic risk can be significant and which cannot be eliminated totally from a single stock. So diversification will help an investor in an ETF, and hence will probably request all investors to look at diversified ETFs rather than investing in individual stock unless you have the right research capabilities.
Definitely, sir. So what kind of investors should actually consider investing in ETFs?
Yeah, so like I mentioned, today in India, we have ETFs across large cap, mid cap, small cap. Uh, we have ETFs in silver, gold. We have liquid ETFs. We have GSEC ETFs. We have smart beta ETFs as well. So across the board, investors have options depending on their return and risk profile. And hence, all segments of market, be it retail, HNI, institutions, can make use of ETFs to create a portfolio for the long run.
So as far as investing in stocks are concerned, there is an ocean out there. However, in ETFs, there are given limitations in terms of choices as well. Given this scenario, what can investors do?
Exactly. So sometimes a lot of choice itself is what makes it difficult from an investor standpoint. And hence, if you look at it, if you have 1,000 stocks and you need to pick up, let's say 20, 30 stocks and create a portfolio yourself, it would mean probably finding a needle in a haystack in terms of finding the right mix, the right portfolio balance, the right exposure levels. All of this, of course, requires a lot of expertise. Let's remember, apart from expertise, it also requires a lot of emotional balance in terms of the ups and downs that the equity markets make one go through. If you are investing in individual stocks, it takes a lot of toll from a time perspective, from a emotional strength perspective, and that can be, let's say, eliminated to a very large extent if you're investing in an ETF, which is anyways diversified and giving you the participation in the market in whichever form you want. Suppose you are a high risk investor, you want to invest in momentum oriented ETFs, you can do that, and the methodology will ensure that every 6 months when the rebalancing happens, whatever is in momentum will be automatically rebalanced. So to the extent the investors time and the investors bandwidth in terms of shuffling the portfolio at an individual stock level will be reduced significantly when you have the option of investing in ETFs. If you are investing in, you want to participate in India's growth in general, you can invest in, let's say, a ETF which has the top 500 names in India, and you'll basically be participating in almost the entire universe of stocks that are there in India, or at least 96, 97% as represented by those 500 stocks. So ETF investing will allow investors to participate while not getting too probably confused as to so many stocks. So the ocean of stocks which you think is an opportunity, we believe that itself is a limiting factor from an investor standpoint, because investors will then have to study 1,000 stocks and pick up 30 stocks out of it, while in an ETF, the 30 to 50 stocks which are there, or the 500 stocks which are there, are already based on a particular methodology. Either they are the large caps, so the bluest of blue chips, or they will have low volatility. So you have 30 stocks which have lowest volatility, which are picked up. You have momentum, like I said. So if you are a momentum player and you like this kind of stocks, you'll get the 30 stocks which are momentum in one single ETF. So there are so many opportunities which are there, and once investors actually make use of ETFs, they'll realize how well it helps them in terms of diversification, as well as reduce a large part of the risk which come with single stock investing.
Yes, definitely, sir. So coming up to my next question. Typically, the performances of ETFs rely on performance of a particular sector. However, in stock investing, individual stock performance matters. How easy or difficult it is to pick a winning stock for retail investors?
Yes. So if you look at from a individual stock investing, much like how we've spoke in the previous question, you have, I think, 3,000, 4,000 stock listed on stock exchange, Bombay Stock Exchange. You have more than 1,000 stocks listed on the National Stock Exchange, and that number is increasing. The number of sectors which are there in India are also increasing in terms of their representation. There are new age technology stocks, there are insurance companies which were not listed earlier. So if we look at from a investor standpoint, apart from the old economy names like oil and gas, cement, there is also new age tech, plus the technology sector, the pharma sector. Within that, then which stock is doing where, and there is so much of complication in terms of which stock does what is the speciality, what is the management bandwidth that the management is able to give to that particular business. For an individual investor to follow so many variables in a single company will require a lot of effort, and hence it is said that investing in individual stocks is a full-time job. If you are in a profession which is different, you may be a doctor, you may be an engineer, you may be working in a different environment, you may be in marketing. It is very difficult for you to give that kind of time unless you're really passionate about individual investing in stocks. And if you're really passionate, then probably you'll already be in the finance field. So if you're in the finance field and do it for a living, it's a different story. But for most of us who are not in that field, it is probably better to go through the ETF route to meet your long-term wealth creation objectives through equity, rather than investing in single stocks, because single stocks, apart from balance sheet, apart from profit and loss, are also impacted by regulatory changes which happen. And that can be a very fluid thing where people have to be following what's happening on a day-to-day basis, which is difficult. Apart from that, of course, diversification, which is one of the tenets which should be followed by everyone, is already taken care of when you're investing in an ETF. So from a investor standpoint, we do believe that if you are looking at diversification, and also today a lot of various opportunities in ETFs are available. Again, to reiterate, if you're looking for large cap, mid cap, small cap, if you're looking for factor based ETFs based on quality, low vol, alpha, momentum, if you're looking at sectoral ETFs also, right? If you're bullish on technology sector, you can have the IT ETF. If you're bullish on auto, you have the auto ETFs now. So infra, FMCG, consumer, commodities, you have a lot of options to choose from. So if anyone is positive on the India consumer sector, you can have the consumer ETF and grow along with the consumer sector. So to avoid yourself the pain of losing money in a single stock, which many people do end up doing because individual stock investing is not easy. If it was easy, then there would be so many successful investors in India, but there are only handful both in India and abroad. And let's also remember that the fund managers who manage portfolios in mutual funds or other institutions, they are they are basically doing it for a living. They put their entire heart and mind and soul in terms of putting their time towards buying the right stocks, the right sectors, and creating a portfolio for the investors. And they are supported by their seniors like the CIO, that is the chief investment officer, or the juniors, which are the analysts, and the entire ecosystem helps them. So it's not an individual job, it's a team job to manage money and buy individual stocks. And if you're trying to do it yourself, then it becomes that much more difficult. So just to summarize on this question, you may find it easy to just hear something and pick up a stock, but if you really want to build long-term wealth, definitely you should look at ETFs, because you have the wide variety of ETFs which can help you reduce the risk of individual stock investing. Thank you.
Yes, sir. Also, sir, investors are allowed to invest in multiple of stocks from a single stock. So what is the minimum amount one can invest in ETFs?
Yeah, so that is also something which is a very big positive, I would say, from an ETF standpoint. That suppose you want to get exposure to all 50 names of the index or the large cap 50 names. If you try to do it yourself in terms of creation of a basket of the stocks in the same index level, then you may need 50, 60 lakh rupees approximately, depending on the basket size of that particular ETF. If you want to buy some individual stocks, there are stocks which are 2000 rupees, 3000 rupees, more than 500 rupees stocks. However, when an ETF is created and that ETF unit is listed on the exchange, there is a very high possibility that a single unit of the ETF, which will allow you to participate proportionately in the underlying index constituents in the same proportion of the index weights, can be as low as maybe 100 rupees, 150 rupees. So with as low as maybe 50 rupees, 100 rupees, 150 rupees, depending on what the trading price of the ETF is, you will be able to participate in the markets in a diversified manner, and you will get exposure to those 50 names or 30 names with as low as 200 rupees. So the beauty of ETFs is that with as low as maybe 50 rupees to 200 rupees to 300 rupees, you are getting exposure to underlying 30, 40, 50, 500 names, and you're getting a proportionate share. So, which you will not be able to do in individual stocks, because there are stocks itself which are probably priced 4,000, 5,000, 3,000, 2,000, as the case may be. So that's the beauty of ETFs, and hence, from an individual investor standpoint, even if you have, uh, let's say, smaller savings and you want to invest in small amounts on the exchange, you can do that with the help of ETFs, 100 rupees, 200 rupees, 300 rupees. While if you do for an individual stock, it becomes that much more difficult. Thank you.
My next question to you is, investors looking for a regular income stream can invest in high dividend yield stocks. So ETFs also pay dividend to their investors?
So, if we look at from a taxation standpoint, for most investors who are in the higher tax bracket, if they get dividend income, you have to pay marginal tax. When I say marginal tax, whatever is the rate of tax that you are liable to pay as an individual, that you'll end up paying on your dividend income as well. So, if you look at from a investor standpoint, it is better that they allow the dividend to come to them in the ETF itself, and then the ETF will keep compounding and growing. So instead of you getting the dividend from the company, the ETF will get the dividend from the company, and that dividend in turn will keep on growing in line with that particular index, because it will get redistributed in that index. If you get the dividend, the money gets out of the investment, it comes into your bank account, you have to pay tax on it, and that basically means your compounding effect reduces significantly. So, apart from the taxation disadvantage that you get when you get dividend in your hand, while if the dividend comes in the mutual fund, it is not taxed and it keeps compounding. You also will probably see that if you invest in an ETF and it keeps getting dividend, and there are some of the PSU ETFs and some ETFs which have a higher dividend yield. If that money comes into the fund itself or the ETF itself, it is better for the investor because they don't have to pay very high taxes on it. And it also leads to power of compounding, improving the long-term wealth creation of the investor in the ETF from the dividend amounts which are received from the underlying companies. Thank you.
And so, how liquid is investing in ETFs?
So, from a ETF liquidity perspective, because they are a group of 30 stocks, 50 stocks, and there's an authorized participant or market maker on the exchange to ensure liquidity, it is a very seamless way in which investors can get in and get out. And from an investor standpoint, we do believe that liquidity on ETFs is not a concern. While there can be certain stocks which can end up having liquidity issues, in fact, if it is a mid cap, small cap, there can be a downward circuit, upward circuit. So there could be circuit limits and filters as well. But ETF being a diversified set of stocks of 30, 40, 50, 500, in terms of diversification onto number of stocks, depending on the methodology of the ETF, you don't have to worry too much about the liquidity part in an ETF. And that's also one of the strong reasons why small and retail investors should probably start their journey and continue till they understand markets through the ETF investing route rather than investing in individual stocks and then probably getting beaten by the markets when the markets become volatile. Thank you.
So, my very last question for this episode. In terms of taxation, do ETFs offer additional tax benefit than stocks?
So both ETFs and stocks have a similar taxation, which is essentially they are taxed if you hold for more than 12 months, which is equity ETFs. I'm comparing equity ETFs to individual equity stock investing. And equity ETFs are again defined as those ETFs which have more than 65% of their investment into companies which are domestic oriented. So, and most ETFs which are equity oriented have that. So, if you are investing in an equity ETF or an equity stock, your tax treatment remains the same. If you own it for less than 12 months, then you are liable to pay short term capital gains tax. If you own it for more than 12 months, then you are liable to long-term capital gains tax. The short-term capital gains tax for those who hold it or trade it out before 12 months is 15% plus the requisite additional taxes or surcharges. And for those who hold the ETF or the stock for more than 12 months, on the capital gain, you will be liable to pay 10% plus the additional surcharge, etc. So in terms of taxation, there is no difference between an ETF and a individual stock. But yeah, the dividend which is received by an ETF, since it is received by the ETF and it is reinvested, the investor does not pay tax on it. You end up basically paying the tax on it based on your marginal tax. Thank you.
Thank you so much, sir, for joining us today. Our listeners will surely benefit from the insights and details discussed in this episode. With this, we come to the end of today's episode of Investment Made Easy podcast. Listeners, we hope you have really enjoyed our conversation today. Please don't forget to share your comments and feedback. You can also share your suggestions and questions at editor@outlookmoney.com. We will be back soon with our next edition. Till then, stay safe, stay invested, and keep following Outlook Money, your favorite personal finance magazine. Thank you.